everyone. Good to see a lot of familiar faces and some new ones. I am Darris, Cassidy. Spoken with many of you over the years. I'm a principal of Fairway and at Verivest, and have been the primary capital raiser for Fairway for the last 10 years or so. So I'm going to take the kind of side or position of investors and try and ask some questions and talk through some things for investors. And with me is President of Fairway America, Adrian Boly. And I'm going to ask Adrian to talk through more of the deal structures, as well as some of the ways in which Fairway underwrites deals, looks at things such as rental rates, whatnot. So with that, we'll get into it. Our disclaimer here, this is not any investment advice, so don't take this as investment advice. So a lot of times when investors call in and want to chat about investing and what options they may have, they tend to be somewhat confused, not sure whether syndications may make sense, funds, whatnot. So the whole goal of this presentation is to try and provide a bit of a process for investors to follow. So these are the things we're going to go through throughout this presentation. We're going to fly through a few of them because they're more basic and several of you have a good understanding of them, but we'll touch on them nonetheless, and then get into some more detailed analysis and things to look at as investors. So first up on this list would be to fine-tune your investment objectives. So again, a lot of times people don't really know maybe what they're looking for. As Matt said, even when they think they know that they want cash flow, sometimes they end up investing in something that doesn't produce that. So, you know, there's things to consider before you even really start looking or shopping for investments. You know, how important is liquidity versus illiquidity? Adrian will get into some options there as far as funds versus syndications. You know, is a K-1 tax form okay, or do you really need a 1099? Timing considerations can come into play there. And then how long are you okay having your money tied up? There are some investment options that are projected to be shorter holds, some longer holds. How much does that matter to you? And then whether or not cash flow is important, or you are more so going for appreciation, longer-term wealth generation. So with that, Adrian, if you can talk us through funds and syndications first, and then the rest of it.
Certainly. Good afternoon, everyone. I'll start really, as Darris mentioned, he's focused, I think, from a Verivest perspective. As president and head of investments at Fairway America, I'd like to delve into a little bit about the fund versus syndication and those products, which we both focus on, as well as other investment managers here. Really, I think when looking at this pathway, this decision tree, fund versus syndication, I think it really starts with a holistic assessment internally, each investor, about what is the key priority. For example, risk assessment, right? And then how do you want to mitigate risk, and how much active involvement do you want in this vehicle? So for example, a fund model is probably the right fit if you have less desire for active management, but you want to see more diversification of your investment, specifically through a security instrument that really relies on the manager to make a wholesale investment decisions across a broad-based set of assets in whatever asset class it's targeted, versus a syndication effort, which requires a lot more active involvement in terms of evaluating the deal itself, and because it's concentrated. So there may be an element of comfort there in knowing that you've drilled down into the deal itself specifically, but it's also concentrated as well. So there's less diversification benefits. Certainly with a fund versus syndication, redemption is a key feature, more prevalent in a fund model depending on open versus closed-end structure, and certainly public versus private. With a single asset syndication, redemption is far harder to happen, as Matt pointed out earlier, in evaluating strong sponsors to partner with. And when you become a limited in a JV SPV, it becomes much more challenging to find liquidity if that is necessary. And so, you know, essentially you bought it and now we have to see how the asset performs within that element. So that's a key consideration to think about in terms of the grander context of how do you ultimately assess your own risk tolerance and what are the key levers that you want to pull as you evaluate each investment opportunity. Debt versus equity investment characteristics. So this is another element too of assessing first and foremost as an investor, what is my risk tolerance? Where do I want to play in terms of the capital stack with private investments, private assets, particularly real estate? So as you've heard from a number of our attendees here and presenting sponsors, there's debt versus equity, right? And so debt has a senior position to equity holders, right? The first loss position is with the common equity typically. But for that, you're trading essentially upside return potential for a fixed coupon. Tax reporting is much simpler, 1099 form instead of a K1 typically with an equity position. No depreciation benefits and distributions are considered pari passu. So with an equity investment though, I mean, this is typically what we think about when we're looking at private real estate in general is there is considerable amount of risk. Like this is a risk on asset class. And for that risk though, there needs to be commensurate upside return potential. And so this is just a different profile and fits into the tolerance bucket of where you assess yourself individually as an investor. That's very important to consider. The tax form is typically a K1. So there's a little bit heavier lift with your own personal return filing and certainly the sophistication of the accounting team that you use to file your personal returns. Rental income is taxed as ordinary income. Sale proceeds are typically long-term cap gains depending on the business plan and the execution of that. There are depreciation benefits that are passed through to investors, but the distribution and the timing of those distributions vary widely, right? A debt instrument usually has a static coupon, but equity typically we like to look at current yield, but it's a total return vehicle, so you have to think about it holistically across the entire scope of what happens with those variable cash flows.
Okay, so Adrian touched on the risk of some of the debt versus equity, funds versus syndications, as well as what happens to those profits. Adrian, can you talk us through, Matt really covered a lot of this, but some of the manager risks, and then we'll get into a few other risks for investors to look out for.
Yeah, this is really, for us at Fairway, this is the key element, right? I mean, I think evaluating our operating partners and finding the best-in-class operators to do business with is fundamental to having a successful investment and multiple investments, right? And it's real estate specifically, but private assets are, of course, typically very illiquid and they're long duration plays. And so when you make an investment, it's very challenging to know how will this play out? And ultimately, one of the first questions that I typically like to ask, and I would encourage all of you as well, is track records are retrospective. And what I want to know is, all right, I see the total return. I know exactly what you've done. But tell me about your worst case scenario. Tell me about the deal that didn't go well. Tell me what you did to mitigate those issues and how did you work through those? Because I think, especially as we look at the last 10 years, real estate has really been a bit of a momentum trade. And now we're heading into a much different economic climate, which we'll touch on a little bit here and gather some thoughts. How will the managers, not all business plans will go well, so how will these managers work through these issues that are really systemic risks that none of us could really prepare for or even predict today, let alone where we'll be several years from now? And so ultimately, we spend a lot of time looking at competency, their contingency plans for key man risk, their cash controls, right? So how liquid and what's their ability to source liquidity in order to finish out business plans, reporting style and frequency, how transparent are they? And then obviously integrity, right? Show up, do what you say you're going to do, and keep showing up ultimately. So that qualitative assessment is probably one of our most important pillars at Fairway that we look as we evaluate each new operating partner.
Yeah, and then as we get through the person in general as a manager, then we're looking at execution risk, which goes just beyond the individual, but their abilities to navigate through situations. So maybe touch on some of these execution risks that are things that we look at and consider and are always in flux during the hold period of these deals.
Yeah, they are. I mean, as you well know, you get a sponsor's pro forma and there's 100 levers to pull, right? And really return profiles can be manufactured in a variety of ways. And ultimately, we usually set aside the return profile and we focus on the risk. What is the business plan, namely to sponsor quality? What is their ability to execute this plan? how detailed is it? And then we work backwards from that risk profile, and we build up our own analysis fundamentally of where we think the true value lies in this asset. And then we try to have a collaborative discussion with the operating partner about these items, right? What's the construction scope of this business plan, right? How many dollars are going into it? We really focus fundamentally on value investing, controlling our basis, evaluating the location, and then wrapping up those aspects within the sponsor and their ability to execute. So what is their niche? What is their comparative advantage? Do they have an in-house leasing element? Do they have an ability to source accretive financing? Can they mitigate entitlement risk? And then ultimately drive value at the sales and disposition moment for the asset. There are just so many areas to evaluate, but I think if you start from a risk perspective and then drill down into what those levers are and how they need to be pulled, and ultimately, the most important lever, I think, is price, right? So how do we get in and control our basis? Because basis, buying right, ultimately solves a lot of issues that we otherwise couldn't predict, or variables that may come up that will challenge the business plan.
So I know that you and some other panelists are going to talk about the market in general, but maybe talk through underwriting risks. So some of the variables that go into the financial models that ultimately impact some of the return metrics we'll talk about here in a second.
Yeah, certainly. So we have it a little bit lower on the list here, debt terms financing. I tell my team all the time, really deals are made at the margins through the financing. And how financing can drive and, of course, leverage is a multiplier, force multiplier on a total return profile. But what is being traded for that, right? It's like taking a prescription medicine, right? Like it solves one thing, but what are the side effects associated with it? It's very important to think about layering in financing in a capital stack structure where there are multiple off-ramps and multiple ways where if this business plan didn't go correctly or how we anticipated, let's say construction costs escalate, we need to put more money into the deal, or it's not the right time to sell. What are those off-ramps and contingencies built into the financing itself that can be the safety net? So it goes beyond. I mean, we spend a lot of time on a top-down analysis, so we look at macroeconomics, but it's also a bottom-up, and those two aspects need to meet itself. So rental rates, for example, conducting a supply-demand analysis, right? Like, what are the main drivers of this real estate, and how do people fundamentally use it as well, right? So we can be very quantitative, we can put it into a spreadsheet, but ultimately, why I think real estate is so attractive, it's a very tactile asset class. You can touch and feel it, and you can make qualitative assessments about how people use this fundamentally every single day. I mean, when you think about the import of real estate in the built environment and what it does and how it changes our perceptions and how people use it over time, those secular trends are very important because I think, ultimately a business plan may need to be extended. So then how do we think people will use that real estate over the long duration for the asset class itself? So all these aspects, whether it's cap rates or hold period, what have you, we don't really get into attempting to predict the capital markets, and certainly right now, with the amount of volatility that we're seeing, it's anyone's guess where we think cap rates end up, really being driven a lot by escalating financing costs. Ultimately, how much value can be generated in the business plan? Can we get to positive leverage? And what does it take to do that? So it's a very quantitative meets qualitative mixture, which, I've been doing this almost 20 years now. And every time I think I have it figured out, I have a stark reminder that I need to keep at it. I think it's endlessly fascinating.
So some of the fees that are charged on these deals, and maybe we can get into how some of the investors can start to look at some of the market risks and the economic risks that you mentioned a little bit. But, one of the sayings at Fairway, at least, is just to put fees where the work is. So if managers are charging fees that are not appropriate or there's not actual work, then obviously that doesn't fly. But as Matt mentioned earlier in a session, it is important for managers to get these fees. A lot of times the way in which they're paid really happens at the end of the deal, which, maybe 3, 4, 5, 7 years out. So anyway, Adrian, maybe talk through some of these different fees, what they're for, why they exist, maybe there's some that you could even give a range if appropriate.
Yeah, I mean, ultimately, Darris touched on it. There is a balance to strike, right? The way Fairway looks at it is we certainly want our operating partners to make an appropriate, rational fee for the services being delivered. We also want to balance that, though, with making too many fees on the front end, which, if we do our job right in evaluating and picking the right operating partners, usually isn't an issue. But it can skew the alignment of interest when too many fees are being pulled out of the deal on an ongoing basis, right? Because the real profit center is the carried interest, the promote structure, right? The disproportionate share of profits that will go to the sponsor for executing and delivering a lot of value to their investor members. So at the start, there's typically an acquisition fee, and that is usually sized off of purchase price of the asset itself, and that can range, depending on deal size, somewhere between 1% and 3% in the aggregate. There's typically an asset management fee of that because there is an overlay that happens in making sure that the deal is executed upon appropriately. That needs to be balanced in with property management. There's also a fee for services. Sometimes sponsors will have their own in-house vertical integration, and so they're really doing all their management themselves, so it can be hard to distinguish what's asset management, what's property management. But a fair, rational fee load is typically negotiated whereby they're making enough return where it helps keep the lights on, as opposed to, is this disproportionate for the work being done? And that typically an asset management fee ranges somewhere around 1 to 1.5% of equity. That, as the deal gets larger, though, those fees actually proportionally come down because it's also about absolute dollars too, right? I mean, and managing that with the sponsor's back of house architecture as well as their headcount. Legal, marketing, accounting, these are typically deal level costs. Administration as well, that can be a fund level cost. And then at disposition for fees, that does happen in the industry, particularly in middle market, sub-institutional, private real estate. At Fairway, we typically don't sign up for that with an operating partner, and the reason why is because usually if the deal goes well, the reward is in the promote interest. And so in our view, it's a little bit double dipping, but that being said, that has happened. It's just not something that we feel like drives a lot of alignment between sponsor and the investors.
Okay, and so you've used the term promote several times, and so different people call it different things. Waterfall is part of getting to the promote. Profit splits is another way of saying promote. So typically the waterfall is the order in which the returns are distributed to the investors and to the manager. So oftentimes there's a preferred return, usually around 8%, sometimes a lot lower, sometimes a little bit higher, followed by the return of capital, which typically happens either at a refinance and or a sale, most often a sale. And then whatever is left over is a pool of money that then gets split between the manager and the investors. And that's oftentimes 80% to the investors, 20% to the managers. Of course, that can vary, 70-30, 60-40, 50-50. It's all over the map. Sometimes that's the only split. Oftentimes in Fairway's deals, maybe you can comment on this, Adrian, there are often hurdles. So it'll be, say, an 80-20 split until that investor achieves a 15, 16% return, 18, whatever it may be. And then anything left over, there's another pool that gets split again, usually at a split more favorable to the manager. So anything to add on the waterfall structures or why some of this occurs?
Yeah, it's an incentive to the sponsor to try and hit the deal out of the park in terms of a total return profile. And there's 100 different ways, and I'm sure you've all very familiar with how many different iterations there are of this sort of structure. I would say the way Fairway we try to look at it is certainly we want to reward our operating partners for a job well done. And so we'll usually try to back weight a lot of that promote. If it is a home run, give them a really lucrative split on the final hurdle. And in our minds, it's all proportional, right? So if this deal solves and ultimately generates let's say, call it a net 20% IRR to the investors over the whole period, we feel like our partners should be rewarded for achieving that. They're not often Those are hard deals to come by and certainly harder to execute on. That needs to be balanced with the risk profile of that deal. What does it take to get there? And in an efficiently priced environment, those are usually very challenging to find. So I know Darris will talk on this in a little bit, but certainly weighing the IRR based on the absolute dollars that are generated, that is something that we work pretty hard to evaluate and then, as I said, match that to the risk profile of the deal.
Yeah, and maybe just to touch on the preferred return, this comes up a lot as to what is a preferred return. It can be confusing. It looks like interest. It's stated as a percentage. And so a lot of investors may have the feeling that it's a guaranteed payment or they're not really sure what the preferred return is there for. And really, one way to think about it is that first hurdle where the investors get 100% of the returns until the preferred return level, right? 8% or whatever it may be. A big part of the reason that it's important to have preferred returns in most structures, not all, is because it incentivizes the manager to keep on track from a time frame perspective, because that pref is ticking, and the longer it goes, the more it's generally accruing, if not paid current. And so it keeps the manager kind of moving down the path of executing.
And there's one more element to that as well. So Darris did touch on a preferred return is essentially every investor gets a pro rata share of every dollar generated up to that percentage, return of capital, and then the percentage, whether it be 8%, 10%. Typically, and Fairway really impresses upon this, we want our operating partners to put skin in the game. So that's called a co-investment amount. It's usually somewhere between 5 and 10% of the equity commitment. We feel like that aligns tightly interests when they have their own working capital within the deal alongside the investor set. And so that means all the investors are getting the return of capital and 8% pro rata, including the investment manager. So they're incentivized as well to see a minimum threshold met because their money's at work as well.
Yeah, good point. So Matt touched on this, but I see a lot of investors that are really shopping deals based on IRRs, return metrics. And one thing I want to just touch on and demonstrate, because I've said this a lot over the phone, it's hard to really get the point across over the phone, but really want to demonstrate the sensitivity of the two variables in particular and their impact on return metrics and how easy it is for managers to manipulate these two variables in order to make the deals look better than they are. Specifically, the two variables are the exit cap rate, and we can get in, maybe you can describe what a cap rate is in a second, but also the hold period. That's an obvious one, just how long from acquisition to sale. So what you'll see on this table, and we'll go to the next one afterward, is the sensitivity again. So this is the same deal, and you can see that if we underwrote this deal on a 24-month hold and a 4.75 cap rate, we would go out to market and show we're going to make a 34% IRR. Well, that same exact deal, if we said, well, instead of two years, it's going to be 5 years, but same cap rate, you can see in the bottom left corner, the return drops pretty significantly down to a 19.8. If you then add time onto that and you go over to the right-hand bottom corner, and it's a 5 year and only 100 basis points in extra cap rate, which is very minor relative to what it could be, you can see that this deal may produce a 13.3. So the point of this is that you really need to understand how managers are using these two variables in particular, because maybe the deal, they think it's going to be a 5 year hold, but that's hard to market those returns. So even though that's the game plan, they might come out and say, well, it's going to be a 3 year hold, and that bumps up that IRR they can go out and market. Similar but different are equity multiples. Same concept, but in this case, extra time, longer time, increases the returns, whereas longer time on IRRs decreases the returns. So you have these two return metrics that are a little bit at odds and move different with different variable characteristics. So it's really interesting to really study and understand the impact of those two variables in particular. The hold period is relatively easy. Not easy, but it needs to make sense how long you're going to hold, how long it takes to execute, how long it takes to then sell the property. The exit cap rates, and this is what I'd like you to touch on here in a moment, Adrian, is the exit cap rates are a complete guess to some degree. I mean, there are historical trends. There's what the cap rates are today. There's where you think interest rates will be upon exit. But at the end of the day, that's the hardest variable to nail down, and it's maybe the most impactful in these financial models.
That's right. I mean, it really does have a large impact on the ultimate terminal value of this, right? Because most of these assets, especially the business plans that we've been investing in, where we're more mid-late business cycle, it's a total return. They're priced efficiently, so that means there's lower current return that's coming off of the real estate for the common equity. And so much of that value creation is back-weighted in whatever that terminal cap rate is. I mean, ultimately a cap rate is just, it's like a dividend yield, right? Assuming the real estate had no debt attached to it, what is the current return we would expect as a perpetuity on it? And so the sensitivity of that cap rate is enormous. We at Fairway really try to get away from prognosticating, trying to predict what we think the cap rate will be. We focus more on cash flow and value creation through how well our operating partner can move net operating income. We want to get to positive leverage over fixed rate financing as quickly as possible, because at some point, and this is what is really important about 3 versus 4, 5-year plus business plans, is things happen macroeconomically that none of us could predict. We may need to hold on to this asset class. Real estate can be a long duration play, and honestly should be if it is cash flowing and it's staying ahead of the financing costs. And so if we feel like in a deal we can underwrite positive leverage where we're making a spread on a stabilized yield over whatever our financing is, then we can be opportunistic about whenever we sell this asset. It really doesn't matter what the cap rates are. We'll just keep collecting the income off of it. But we will be opportunistic as well. Hopefully the capital markets normalize here in the next year or two, and then we can sell into a market with our existing assets where it makes a lot more sense, and instead of unloading now where the terminal value, unfortunately, will really impact the levered return on it, as well as the equity multiple.
Again, hopefully this helps lay out a bit of a process that investors can follow as to how to look at risks. There's some that you're going to have to trust in the manager, which again comes down to choosing the right managers, just because we just went through 20 years each of experience in 20 minutes. So let's do some Q&A here, but one thing you just mentioned several times that I didn't have in the deck that I think is important to understand given the market environment we're entering is this concept of positive leverage. And in simplistic terms, it would be that you want your debt cost or your interest rates to be below the either cash flow or the cap rates. And that has been relatively easy to do. But we may be entering a market that positive leverage may be more challenging, which means negative leverage, where you're borrowing, say, 10% interest debt, but you're investing in something that only produces a 7%, yield. So that's obviously not a good investment. That's a very simplistic way of explaining it, but that's basically what positive leverage means. Is anything else to add, or we can jump into some Q&A here? We got about 10 minutes for that.
Yeah, let's jump into Q&A.
Okay. Any questions? And I think there's some microphones around.
Is there a time or when you would opt to break your rules that you just told us about?
And the question was, is there a time to break our rules? And which rules? Like underwriting type rules? Or?
Right, and cap rate with cash flow and economic positive leverage and so on. When do you break the rules? Or do you break the rules?
Every deal stands on its own, and I wouldn't say it's so much breaking rules as it's prioritizing often conflicting rules. And I think that's very much driven by where we are macroeconomically in the business cycle, right? And so real estate has done extraordinarily well the last decade, no doubt about it, to the point where many value-add business plans really didn't even need to be executed because there was another buyer who was willing to pay more. that is, in my opinion, dramatically shifting. And at Fairway, we are preparing and have been preparing for that event for a year now. There are also other elements as well where, for example, real estate is usually, over the last 30 years, real estate returns are very strongly correlated with inflation. So positive inflation flows well into private real estate, depending on asset class. And I think that now is a feature which wasn't really appreciated by private real estate, which is now a massive inducement for allocating to this asset class. This is why Fairway, we've shifted pretty heavily, for example, into housing of a variety of strategies, because it is a natural hedge to the inflation that we're seeing now in the economy. That being said, we now have to counterbalance that with what the Federal Reserve is doing and driving up interest costs really across the board for, essentially setting what a risk-free price is, and then everything else above that is now scaling. That's eroding into NOI significantly. And so this gets back to my previous point about knowing what the manager, tell me about your worst deal, right? Like, how did you navigate through that? Because I think strong operators will really be able to show themselves well over the next few years, because the easy money's been made. We're headed for some pretty challenging economic environs now, and we'll get into more of that in a later panel. So,
What are some of the leading indicators you look at?
The question was, what are some of the leading indicators
for the business cycle? Well, it depends on
certainly interest
how
rates.
wonky you want me to get on this.
Yeah, and it also depends on the asset type, asset classes,
Yeah.
right? So like if you're talking most asset classes, interest rates is obviously a big one. Cap rates tend to correlate and lag where interest rates are. If cap rates rise, values generally drop. So that's the basis of a lot of it.
It is.
And then it's supply and demand metrics, obviously. Office has a lot of supply at the moment, or vacant supply, I should say.
And ultimately just really trying to buy right, make money on the buy. That, honestly, in my experience, solves a lot of issues. Not all of them, but it's just you create a buffer for when times get tough. You need fewer tumblers to fall into place versus 7, 8, 9, right? And so it's the deals that are at the margin, which we try at Fairway very well not to compromise on too many of them, right? And it really starts first and foremost with value investing, and then understanding the location of the real estate, and then how people use that real estate. And if things change dramatically in one of these aspects in the economy, hopefully we've done our diligence well on the rest of those aspects, where that's our natural safety valve in the deal.
Yeah, but by buy right, one way of looking at that, to add to Adrian's comment, would be to get in below replacement cost, right? What does it cost to build that same building today? And given where labor, construction costs, land values are today, that's a big part of it, because you'll see in recessions that values may drop below that replacement cost, but they tend to generally snap back to that relatively quick, and then may take time to recover from there. So that's a big part of how you get into them. Any other questions? Yeah. And Kellen's running a mic, then we'll come to you, Paul.
Hi. You had a slide earlier with the waterfall of fees. In a situation where you have layered fees with a fund of funds, do you typically see that waterfall from one fund and then followed by the whole waterfall for the next fund? Or is it like one step is this fund and then the same step for the other fund and then the pair?
Right. That's a great question.
Thank you.
You're welcome. Let me kind of restate it in a different way. The question is fund of funds. So one fund has a waterfall that invests in another fund that has a waterfall. If you're at the bottom of that, you just got diluted twice. Basically, you paid. A simple way is if there's an 80-20 split, and then there's another 80-20 split, then it's a 64-36 split at the end of the day, not 80-20, even though the vehicle you invested in said 80-20. So the answer is generally no, it doesn't show the full dilution. It shows that you invested in an 80-20 deal, even though it's truly a 64-30 or whatever that math is that I just said. But right? So
That's right.
So if you are investing in a fund of funds or an allocator type model, or anything that's investing and has a waterfall that invests in something with a waterfall, you need to ask the questions and dig into what that dilution and that math looks like. Most people, not because they're necessarily trying to hide it, but I think it's not generally disclosed fully. It may say that you may have that situation, but the math isn't laid out very clearly.
My question runs to the enforcement of some of these guidelines or rules. How often do you find yourself either declining to put out an offer or negotiating with the sponsor to bring down some of the promises? How often does that happen?
Every single deal.
Yeah.
And
Yes.
it really is. And so, I mean, it's not, we underwrite at Fairway every single deal hand in hand with our sponsor partner. And so part of the value I think that Fairway brings to the equation is really we, based on our experience, our subject matter expertise, just our breadth in the space, we, I think, bring another perspective that can help build a better business plan overall. We're pretty selective about the deals that we do elect to proceed with. But that being said, we attempt to build long-term relationships with operators who are best in class, who we know can drive value through multiple economic cycles. Not every single deal they bring to us is one that we'll do, and that's totally okay. We like to be a quick read, and we'll be very transparent about why we are struggling with the deal. And look, I'm not an expert at all. I learn something new every day in this business, but ultimately, they can go off and elect to proceed with it, and perhaps we're wrong about it. We try to do the best we can in the current environment with the facts that we have. But, it's an imperfect science, and we want to really pick our spots well. So every single deal we're underwriting, and the value I think that brings is another perspective, but also a mitigant in terms of counterparty risk, right? It can be hard to know who to do business with, but Fairway, we hope to filter and find partners that we can do fewer, better deals with, ultimately, is our goal.
All right, we're going to wrap it up with that and move on to the next one. Thank you, everyone.
Thank you.